Hello, everyone, and welcome back to Your Finance TV. As is always on a Friday, we're here with Jay from Jay Pelosky for his Friday musings, and I'm a little frazzled because the markets are a little frazzled. It's a little bit volatility out there at the moment, Jay. How are you handling it all?
Well, I think the title. Well, first of all, thank goodness it's Friday, right? I wouldn't want another day like the last couple. And great to see you, Scott, as always. But the title of this week's musings is Flip Flop, and I think it's a great time to have this conversation because markets are chaotic. They're flopping and around like a fish out of water. People checking in from the beach, right? Watching their portfolios melt away. So I think a great time for the musings. And look, the title, Flip Flop, really reflects the speed and scale of some of the moves we've seen in the markets recently, right? From AI tech enthusiasm to AI is overblown, from rotation in the small caps to we're going into a recession. And we see the same thing in the data, right? I mean, the data has been all over the place from having really good inflation and by the way, also really good productivity data. That productivity data is, I think, very important to having, really kind of questionable jobs data to, 4.3% unemployment rate into an ISM, an ISM manufacturing number yesterday that I think really, really shocked a lot of people. And so I think there's a real concern about the rotation that people were taking comfort in, right? People were saying, okay, AI is a bubble, so let's rotate a little bit. That rotation, people kind of took and ran with it, but now that's being questioned. And I think that leaves us with, as I say in the title, a flip-flopping market.
Jay, there's been a lot happen, like especially this week. Right? If you're talking about, you touched on small caps there, IWM, the ETF for that had an amazing run over the last few weeks. It seems it was like just run into a brick wall. You've got all sorts of different types of media saying buy small caps, valuation small caps underdone, rotate out of this, rotate into that. Like there's just so much noise and everything coming at investors, both institutional and retail. Like, what do you make of all of it?
Yeah, no, I think that's exactly right. Got a lot of discussions over the last couple of days, right? It's always interesting when things are going fine. The phones are quiet, no big emails, things are just chugging along. And then when you hit a volatility period like we have these last couple of days, really the last couple of weeks, all of a sudden the inbound traffic picks up and people want to know what one thinks, and that's great because we do at TPW Advisory, we do kind of pride ourselves on having a point of view, even in challenging markets like this. So, I mean, I learned way back in the day at Morgan Stanley that, when the S hits the fan, that's when you're supposed to be visible, right? And so we pride ourselves in this video. We're excited to do it today with Your Finance TV because it's an appropriate time to, take a pulse check, take a gut check. And so our takeaway is that we are still believers in rotation versus recession. We would look at things like the ISM jobs number, which was a real shocker, down significantly. In fact, back at levels that have last been seen when COVID really hit, and before that, the great financial crisis. And I think that tells us something, right? That tells us we're not in anything like that environment, those environments. And so we think there might be a little bit of hurricane barrel in some of the data and some of the survey data that we've seen that have really shocked people. And another example is the rally in rates, which is now extending for 9 straight days. And we saw the other day that an 8-day streak was last seen again when COVID really hit back in March, April of 2020, so 4 years ago. And again, we're not anywhere close to that type of environment. I think a lot of it is that, and we've touched on this in some of our writing recently, is that the day-to-day action in markets is driven now increasingly by algorithms and by machines. And so everybody moves in the same direction and moves very quickly. And that move just overwhelms any kind of, traditional buying and selling and stepping into the gap, so to speak, and taking on the other side. People know today you can't really take the other side in the very near term because the machines control so much money, you're just going to get overwhelmed. And so I do think we see things like, 9-day rally in interest rates, even though the economy is fine, right? Q2 GDP, we just got the number, 2.8%. So to us, it's a little overblown, and it's important to kind of parse the data. It's important to have a point of view, and it's important, obviously, to question that point of view and check that point of view. And believe me, we're doing some of that, as we'll get into here in a minute.
Obviously, big week for earnings, Jay. We've talked about that a lot in the past. There's been some misses. If you want to look at the likes of an Intel, which might be a little bit different compared to your average Joe Blow, but there've been some good earnings as well. What do you think of these earnings, and what do you think about the economic outlook for the economy as well?
Yeah, and earnings are key, right? I mean, you can talk about the economic data flipping around, and you can talk about rates rallying. And by the way, importantly on that rate front, credit is still holding in there really nicely. And some folks are talking about the widening of credit spreads versus treasuries, but I think that's mostly because treasuries had a 9-day rally, right? It's not because credit, particularly you look at things like HYG, the high yield ETF, it's still, it's down, but it's down marginally, and was had its high, recent high just a few days ago. So credit is holding in, and earnings are more than holding in. So JP Morgan just put out, they do good work on the earnings front. They're a go-to source for us at TPW Advisory. Just put out a data point today, or a report today, saying that roughly 65% of the S&P has reported. Earnings growth is running at 12% year over year. That's a significant increase over what was expected at the beginning of the earnings period, which was 7% earnings growth year over year. So earnings are coming in better than expected, double-digit earnings growth. And by the way, it's not just the case in the United States. That's U.S. data. In Europe, earnings are also coming in roughly 1% year over year. But again, a pretty significant surprise. Earnings were forecast in Europe to be down year over year by about 2 to 3%. So a significant beat occurring in European earnings, and as well as in Japan, where earnings growth is running at about 5% year over year. Again, better than expected. So earnings currently, so we are looking, it is backward, it's Q2, are coming in better than expected. Importantly, we also want to be looking at forward earnings expectations, right? Because markets are forward-looking discounting mechanisms. And so importantly, forward earnings estimates, 12-month forward, are also continuing to increase. In other words, analysts are hearing the stories from the companies reporting and raising their 12-month earnings estimates. And that is not what you would see if we were running into a big recession, right? If we were going into a global financial crisis, if there was a pandemic, starting to become visible. So, and those forward 12-month numbers are robust, double digits in both the U.S. and the Asia Pacific, with Europe 12-month forward running at about 8% year over year. So for us, those things are really, really important and give us the comfort to say, we are believers in rotation and broadening out and continuing of the global equity bull market, rather than recession is coming, earnings are going to get cut, and we have to get very defensive.
Okay, well, listen, we're coming into the middle of, let's call it summer, I suppose. Like, this is the month where everyone really disappears, right? Like, I'm seeing comments come out here today from JP Morgan and Citi saying they're expecting 250 basis point cuts, but they might be sitting on the beach making these calls. And we also know how accurate they've been with these rate cut calls as well. What was it, 7 or 8 I was calling at the start of the year?
Yep, exactly.
Yeah.
6.
Jay, where does all of this leave us? Obviously, you've got your 4 macro points, which we've touched on a lot in this series. Where does this all leave us going ahead?
Yeah, no, obviously that's the key question, right? Where do we go from here? And you're absolutely right. I do want to touch on our 4 for 24 global macro surprises that we wrote all the way back in late October of 2023, and just touch on them because they have been really solid guideposts for us over the course of this year. So number one was lower inflation sooner than expected, right? That's clearly manifesting in the United States. It's manifesting in Europe. And that importantly is giving central banks the okay to start cutting rates. And so we want to remind folks, as we have noted this before, that JP Morgan is looking for roughly 80% of the world's central banks to be cutting rates by Q4. That will be the most synchronized global rate cutting cycle since the early to mid 80s. Okay. Early to mid 80s. I mean, you and I were around maybe for some of that, but very few others were. So that is an important point because it means that central banks have a support function for risk assets rather than impeding them by a rate hiking cycle. And so we think that's really pretty significant and again important, and is a very big change from where we were just a couple of years ago, right? Where interest rates were close to zero at record low levels. And therefore, if there was a problem then, central banks could do very little about it. Here, we have a situation where the room for central banks to cut rates is significant, right? With real rates being quite high in the US and in Europe. And so that's really important. So that's one, lower inflation. Two is better than expected productivity. We touched on it, really important. Productivity growth in the US, the data just came out the other day, running at about 2.5% year on year. That's significantly above trend. That provides us with room for lower unit labor costs, which came in Q2 at the levels not last seen in 2019. So unit labor costs coming in, productivity expanding, that's really good news for corporate margins. And that's probably one of the key underpinnings to that forward double-digit earnings growth that we touched on. Number three, return to stability. And you touched on the VIX, right? The VIX today over 20 for the first time since last fall of 2023. Importantly to note, though, the 10-year average for the VIX is 19. So the fact that we're at 20 today is a little disconcerting because we haven't been there very much in the last year or so, but historically is not even a blip on, real volatility. So that's important. And we again continue to focus on lower inflation volatility as a key to that return to stability. And then fourth, and this is where the question does become a valid question, our thesis that we are early cycle as opposed to late cycle going into a recession. And that has led us to be aggressive on risk and to be overweight things like commodities. Clearly, that has not been a great place to be the last week or two. And we've given back, some gains that we had from earlier this year in our global macro asset portfolio. Where do we stand here at this point? We continue to think that we are in an early cycle global economic recovery. We note that Asia Pacific, which is really the manufacturing workhorse of the global economy, their manufacturing PMI hit a 15-month high in July and has been up 7 months in a row with demand improving and new orders rising. So that suggests to us that the global economy still has some life to it. So where does that all leave us, right, at the end of the day, okay? We are believers in rotation versus recession. We think the speed and the scale of the moves we've seen in the last couple of weeks do represent a kind of new normal where a lot of the day-to-day is algorithmic driven and goes right to important technical levels. Today is a great example, S&P right to the technical support around 5,300. We'll see what happens next. I think that means investors have to decide, do you want to try and trade that action or do you want to ride through it, right? And we at TPW Advisory are kind of a forward a 1 to 2 year holding period type of shop, and therefore we're in the ride through it rather than the try and trade it mentality. And so we're focused intently, as we tried to discuss, on earnings, on forward earnings outlook. We're focused on commodities, really trying to understand what Dr. Copper is telling us, right? Big run up earlier in the year, sharp sell off over the last month or two. We think it reflects more speculative money than it does underlying economic activity, but that's something we're watching. And then the other thing that's really important, we believe, is watching the benefits of lower interest rates on parts of the economy that have been struggling. Real estate, regional banks, this type of thing. We note that the 30-year fixed rate mortgage in the US is back to levels last seen about 18 months ago. That should be constructive for the home building cycle. That in turn constructive for construction jobs, which in turn helps with consumption. So those are some of the things we're looking at. We've made no real changes. Again, we update our models once a month. We haven't stepped in over the last week or two in any meaningful way, and we look forward to updating those models in a week or two. Next week is our monthly. The week after is our model update. But for now, holding firm to the view that rotation will beat recession.
Jay, thank you so much. It's a great breakdown. Nice calming voice and all this time of panic in the markets. Have a great weekend, and we look forward to getting that monthly next week.
All right, Scott. Great to see you. And yes, have a great weekend as well.
For everyone else out there, good luck investing.